This strategy made over $320,000 over the past 15 years and $35,000 so far this year with a win rate of above 83%. To build robust strategies like these, you need good filters. Good filters usually come from volatility and direction. They are not the only ones, but they are the major ones. Today's video is about a direction filter. The indicator you see at the bottom is the Trend Intensity Index. Don't worry about the code for the indicator or for the strategy that we are going to build. It will be available in StudyOasis community, which you can join for free to meet other traders. The indicator has a default lookback of 60 and a default thresholds of 80 and 20. So the lookback of 60 is the moving average. And then we are calculating the difference between the close and the moving average. And we add all these up over the past 60 bars, which is the lookback period. Then we divide it by the total sum, so we get an oscillator that hovers between 0 and 100. And when we are over the 80% threshold, that means we are in a long trend. And when we are below 20 threshold, we are in a short trend. The indicator can be used as a filter for other signals, because it's a trend filter, but also we can use it to generate signals for entry and exit. And that is what we are going to do in this video. Now, because I'm trading the S&P 500 and the S&P 500 is a mean reverting instrument, we need to shorten the lookback period so we make the oscillator oscillates a lot to get more signals in. So by shortening the length of the indicator here, the period is 4 instead of 60. You can see now it resembles the RSI2, which is this one. Now, although there are differences in the magnitude, but basically the peaks and the troughs usually matching almost, I would say, with 90-95% correlation. And now we're looking at these two charts of the S&P 500 futures since 2006. On the left, I have the Trend Intensity Index as our signal generator. So when the indicator below a threshold, we will go long, and when the indicator above the above threshold, we will exit. And on the right here, I'm using the RSI2 strategy. It's the default strategy, RSI2. Below 30, we go long. Above 70, we exit. And we have the 200-day moving average as a filter. And this is the comparison between both. This is our RSI2 strategy, making $196,000 with 39,000 drawdown. And our Trend Intensity Index used as a mean reversion indicator, the strategy is making 166 with a drawdown of 47. Now, obviously, the RSI2 beats this strategy. But here is an interesting stat. So if we look at the number of trades, this is almost 400 trades. Remember, I'm not including commission and slippage because the average trade is too big, so we are not worrying about it. But this is only 60 trades. So 60 trades, but each trade is more than 5 times the average trade of the RSI2. So while they look the same, the numbers tell a different story. Also, the percent of win here is 74%, while here is 82%. So while we are making less money, not a lot less, but we are making less money and higher drawdown, but we are making it with a lot less trades and a higher win rate. Now that also comes with a caveat here. We are staying on average about a week, and here on average about 4 weeks. And that's why we have the bigger drawdown and the Trend Intensity Index. Still, that should not deter you from using this indicator, because we are always looking for more variety in our equity curve, even if both strategies are using the same mechanism. Now we are adding more variety. So the one on the left is the Trend Intensity Indicator used as a mean reversion entry and exit. On the right, I extended the lookback period to 16, and now we are going to use this as a trend following indicator, meaning when it is above the threshold, we go long, and when it goes below, we exit. And now let's look at our performance. Now, with using the indicator as a trend following indicator, we almost achieve the same numbers. So the profit is 163,000, here is 166. Maximum drawdown is 44,000, here is 47,000. The number of trades here is 60, here is 85. So that's a significant enhancement in the number of trades. Of course, that comes with the sacrifice of lower win percent, which is totally acceptable for trend following. In fact, if anything, this is a huge win percent for a trend following strategy, because usually trend following strategies are in the 30s. Looking at the equity curve, we can see they are totally different. Yes, both of them are going up. Yes, both of them are making almost the same amount of money, but this is a lot choppier, which is expected for a trend following strategy, and this is a lot smoother, both of them making the biggest drawdown in COVID crisis. Now, this is an extremely plus point for this indicator, because using the same indicator as a trend following signal generator or a mean reversion signal generator is really an indication of the robustness of this indicator, that you can use it in many situations. And remember, the original target of this indicator is to be used as a filter. So we did not go into filter. So you can use this indicator in three ways: the long-term trend following signal generator, short-term mean reversion signal generator, and as a filter for other strategies. But now that we have generated two separate strategies from this indicator using totally different fundamental reason, one is going with the trend, one is going against the trend. Theoretically, we can combine those two strategies on the same instrument and we should get better numbers. So here I did an optimization for both strategies on the S&P 500. You can see this is strategy 1 and this is strategy 2. So I optimized the look back period, the overbought, and the oversold, with total number of optimizations of 345,000 strategies. So first thing, if we sort by net profit, we can see that all strategies are profitable, more than 329,000 strategies. Of course, this doesn't cut it because it's 9,000 net profit and no commission, no slippage. So this is a losing strategy actually. So if I filter the strategies that are making at least $150,000, we still have over 245,000 strategies that are profitable. And if I sort by return to drawdown, this is the best strategy. So it's making 212 and losing 66. Now, while I did this optimization correctly and I'm choosing methodically, still this is not a robust workflow, which is extremely important to build robust strategy. And that's why I dedicated a full module on robustness testing in my algo trading masterclass. If I pick this one, the $324,000. So on the left here, we have our mean reversion strategy. On the right here, we have our trend following strategy. And here in the middle, we have both strategies combined. First thing I want to bring your attention to is the correlation. So although we are trading on the S&P 500, and although the trend following is holding for more than 20 days, we are looking at the correlation of 0.31 on the daily and 0.27 on the weekly. That is a big plus because that means we are not always trading two contracts at the same time. So 30% of the time we will hold two contracts, but 70% of the time we are holding one contract only. So now we have 152 trades with a 63% win rate, on average making $2,000. And if we look at our periodical returns, we lose 5 years since 2006. And in 2023, we are making $38,000 in 6 trades with an average of $6,000 per trade, 83% win rate. This is our curve. We dip here in 2022 and we just made it all back with new highs in 2023. By learning how to test properly, you can build strategies by exploiting edges that most other traders cannot find. Mixing two types of strategies using the same indicator usually is a good way to diversify your portfolio. To learn more strategies like these, watch this video and I will see you there.